we are looking at a very, very quiet pre-market session on the surface. January 12th.
Deceptively quiet.
Exactly. S&P futures are basically flat, volume is thin. But when you dig into the institutional intelligence, the anxiety is just, it's everywhere.
It is. It's what we'd call a wait-and-see tape, which is often the most dangerous kind. Everyone's just holding their breath.
So let's run the numbers. S&P futures are hovering where? Around 6,140.
Right around 6,140. Incredibly tight range. The Nasdaq 100 is barely up, maybe 0.1%. Even the 10-year yield is just sitting there at 3.92%, pretending like everything is fine.
But it's not fine. One of these reports we have calls it the pre-inflation shiver. I like that. It's not just caution, it's something more.
A shiver is a systemic cold creeping in. That's a perfect way to put it. The momentum we saw in that New Year's rally, it's completely gone, evaporated. Institutional desks are not committing capital right now.
They're sitting on their hands.
Completely. And it's because of two massive external catalysts that are just freezing the market.
Okay, so let's break those down. What's number one?
Number one is the more traditional one, but it feels amplified this time. It's tomorrow's December CPI print. We're calling it the CPI cliff.
A cliff, not just a hurdle. Why the stronger language? I mean, we get a CPI print every month.
Because the stakes are so much higher now. The entire market narrative, this whole Goldilocks idea of cooling inflation and strong growth, it's all been priced in.
So the market has front-run the good news.
Massively. And if that core inflation number tomorrow comes in hot, that idea of a March rate cut from the Fed, it's gone.
Off the table completely.
Instantly. And that's not just a disappointment. That forces a whole reevaluation of the Fed's path for the entire year. That's the cliff.
And if that wasn't enough, let's get to the second catalyst, the one that's really, I think, the core of the problem, this political earthquake.
This is the truly disruptive one. The reports are all over it. The Department of Justice's criminal investigation, a subpoena for Fed Chair Powell.
I mean, it's unprecedented. This isn't just noise.
It's shaking the absolute bedrock. The risk-free rate, the foundation of global finance, is built on trust in the central bank.
And now you have what they're calling Fed independence risk.
Exactly. For anyone listening, think of it like this. The market has always trusted the Fed to make decisions based on data price stability, employment, not politics.
So if that trust goes away, if the market starts to think the Fed could be, I don't know, bullied into cutting rates for political reasons,
then inflation expectations can completely unanchor. The market suddenly has to price in what the Fed might be forced to do, not what it should do.
And that means a risk premium.
A huge one.
Yeah.
A political risk premium on everything. And if we connect this to the bigger picture, that's why the cost of capital is suddenly surging for high-growth tech. Their whole model depends on stable, low rates. This injects chaos.
Okay, so that's the macro fear. How is it showing up on the charts, in the indices themselves?
Charts are screaming caution. We're in what you could call a liquidity trap. The S&P 500 just had this incredible record-breaking run, cleared 6,800.
Right, everyone was celebrating. But the Nasdaq...
The Nasdaq is not playing ball. It's stuck. It's been trapped in a 60-day consolidation zone. It is refusing to confirm the S&P's new highs.
And that's a classic bearish divergence.
Textbook. When the leader makes new highs but the other major index fails to follow, it tells you distribution is happening. Smart money is selling into this strength.
So let's get into the specific levels that the desks are watching. We're talking futures here, so ES for the S&P 500. What's the line in the sand?
The line in the sand is 6,800. It's that simple. If ES can't hold 6,800 on the retest this morning, the bullish story is in trouble.
And the downside target if it fails.
The technicals point to a flush down to the demand zone around 6,720. You have to clear out all those weak late longs.
Yeah.
Plus, the RSI is up at 68. It's screaming overbought.
And what about NQ, the Nasdaq, which is the big drag here?
The pivot for NQ is 25,760. But the real test, the ceiling it has to break, is 25,830.
The top of that consolidation range?
Exactly. It needs a clean, decisive break above that level to get the bulls excited. Without it, it just remains a weight on the whole market.
So the strategy being passed around the institutional desks is what? Fade any morning pop?
Fade the pop if NQ fails at 25,830. The consensus is that this is all a setup, just trapping liquidity near the all-time highs before a pre-CPI shakeout.
Okay, so let's follow the money. Where is capital fleeing and where is it hiding? Where is the distribution happening?
The exits are very specific. First, payment processors. They're getting hammered on news about potential interest rate caps, which is a direct regulatory threat.
And the second area?
The big one, U.S. mega-cap tech. This ties directly back to that Fed independence risk. The money is systematically moving out of domestic names that need that long-term stability.
So if they're selling big U.S. tech, where does that cash go? It has to find a home somewhere.
The flight to safety trade is on, and it's happening in two places. First, the obvious one, precious metals. Gold has just exploded. It's past $4,600 an ounce.
And that's not just an inflation hedge at this point.
No. This is a direct hedge against political instability.
Okay.
When you start to question the foundation of the currency, hard assets always win. So you see flows into ETFs like GLD and the miners.
Makes total sense. What's the second, maybe more surprising rotation?
It's into select international ADRs, and the case study here is Alibaba, BIA.
Right. DIBA is up what? Over 4% pre-market, up to $157.70. Why there?
Because it's seen as completely insulated from this domestic U.S. political drama. It's a simple, liquid way for a portfolio manager to get capital outside of this uncertainty loop.
So it's a relative safe haven. What's the key level to watch for a real reversal?
You need to see it clear $165.
Mm-hmm.
If BABA can get above that resistance, this tactical move could become a much bigger structural shift.
Even within mega cap tech, we're seeing huge divergences. It is absolutely a market of stocks right now. Take Apple AAPL. It's actually up 1.4%.
Apple is an exception. It has its own story. It's getting a boost from reports that its Siri LLM integration is seeing really strong enterprise adoption.
A rare, company-specific growth catalyst.
Exactly. It gives it some insulation from the macro fears.
And then you contrast that with Tesla, TSLA, down over 2% pre-market.
The pain for Tesla is all about competition. New data shows their market share in the EU is eroding because of Chinese EV makers.
The margin versus volume war is back.
It is absolutely back, and the market is pricing in a sustained hit to their profitability.
Let's touch on one more, an old economy name, ExxonMobil, XOM. It's down 1%, but for a totally different kind of political reason.
Right. It's not about oil prices. It's about reports that President Trump has signaled Exxon might be excluded from future projects in Venezuela.
It was so a very specific geopolitical risk to their future growth.
And that's why that $135.50 level is so critical. If institutions think that future is in doubt, they will exit, and they will exit fast.
This all brings us to what might be the single most important number on the screen, the 10-year Treasury yield, TNX. It's at 4.20%. This is where it gets really serious for growth assets.
That 4.20% level is a huge red flag. We're probing 5-month highs, and what you're seeing is something called bear steepening.
Meaning the long-end yields are rising faster than the short end.
Exactly. And it's happening because of fiscal concerns and, more importantly, all this political noise around the Fed. That is overriding any story about cooling inflation.
So the 10-year isn't rising because the market thinks the Fed will hike. It's rising because the market fears the Fed is losing control of the long game.
That's precisely it. The political noise is driving up the term premium. Investors are demanding more compensation to hold long-term debt because they just don't trust the Fed to keep inflation anchored anymore.
And what's the direct mathematical impact of that on the Nasdaq?
It's devastating. I mean, it's valuation 101. A higher 10-year yield means a higher discount rate on future earnings. So all those AI moonshots, all that promised cash flow 10 years from now is suddenly worth much, much less today.
That's the squeeze.
That's the squeeze. It's why the Nasdaq is lagging so badly. The market is adjusting its models in real time.
And we're seeing that pivot away from pure software and towards tangible things.
Absolutely. You see the strength in a name like Vistra, VST, because they're building nuclear power for data centers. The market wants AI infrastructure that produces cash flow now, not just promises of software growth later.
This is a perfect time to define the dovish trap for you listening, because a lot of people might see this political pressure and think, great, the Fed will be forced to cut rates, time to buy the dip in tech.
And that is the absolute pain trade right now. That's the trap. Yes, the Fed might be forced to cut the short-term funds rate, but the 10-year yield, the long end, will just keep spiking because the market's lost faith. It's pricing in permanent, unanchored inflation fears because of this political circus.
So we get this really rare, really dangerous scenario where the Fed cuts rates, but tech stocks go down anyway.
Because the 10-year yield is what actually matters for their valuation, and it's refusing to follow the Fed's lead. The 10-year is basically a vote of no confidence in the Fed's credibility.
What's the critical level to watch there?
Keep your eyes glued to 4.25% on the 10-year. If that breaks, the rotation out of big tech won't be a rotation anymore, it'll be a stampede.
This has been a really critical breakdown. For you, the learner, let's just nail down the three takeaways here. First, political risk is now overriding economic data, period. Second, the S&P and Nasdaq divergence is a massive red flag. And third, the smart money is moving. It's fleeing domestic tech for hard assets like gold and select international plays.
And the bottom line strategy from all this is simple. Trade the rotation, not the index. Be nimble, respect those levels we talked about, that 6,800 on the S&P's everything, and just be incredibly wary of this setup, which, leaves you with a really provocative question to think about.
So on.
If this trust in the Fed's independence keeps eroding, does the 10-year yield effectively become the new Fed funds rate? Does it become the only true barometer of inflation, making the Fed's short-term rate, well, almost irrelevant for valuing the future? It really feels like the political tail is now wagging the economic dog.